Learning objective 2 is going to be how to do the accounting for when a company actually issues stock, which means they're selling stock to investors. And here we are going to look at common stock and something called preferred stock as well. Then the second part of this objective looks at what happens when a company buys back its own stock, which is what we call treasury stock. So that's a lot to deal with in one objective. So that's what we're going to be doing. Okay. So again, for the accounting for common stock really represents common ownership with all of those rights that we looked at in the last objective: the right to vote, the right to preemptive right, preemptive rights, and the right to share and dividend, etc. Those rights are very common. All companies have common stock. Okay, not all companies have preferred stock. So that's something that's really important to know. Common stock is common ownership, right? Common stock is considered paid in capital. Again, the key word here is paid in, right? So how stock works is the owners pay money in, they pay cash into the business. In exchange, they get these shares of ownership. Okay, they get these shares of ownership. So because they literally have to pay in the money to get the ownership, that's where the paid in capital comes from. All right. So that's very, very important, paid in capital. The other the other account that you've learned already was retained earnings, but paid in capital is stressed here. Okay, so when a company goes ahead and issues shares of stock, that means they're selling shares of ownership in exchange for cash. So the word issue means to sell. Okay, to sell. What are they selling? Ownership, shares of ownership. And that's important to sort of understand. So those are some common terms to look at that you see over and over again. So this is how the accounting works when they issue common stock. Now, like I said, from Learning Objective 1, common stock will either have a par value or a stated value for accounting purposes. So this is where you're going to learn about that. Okay. So here we have a company called Hydroslide, and they issue, right? That means they sell 2,000 shares of common stock, but these shares have a $1 par value. Okay. So the first thing we have to understand is that's going to be the value of the common stock account based on the number of shares that are issued at par value. So this is how it starts off. So what is the journal entry if, just looking at A, they issue 1,000 shares at $1 per share? Okay, so they sold it for $1 per share, and the stock has a par value of $1 per share. So both the selling price and the par value are equal. So all the money is going to be credited to the common stock account. So in this case, we are going to debit our cash because they raised $1,000 in cash. That's 1,000 shares at $1 per share. It's $1,000. But because they sold the shares of stock for the exact same amount as their par value, all of this $1,000 is going to be credited to the common stock account. What you'll see is in the next part, they actually sold 1,000 shares at $5, which is higher than the par value. So we treat that a little bit differently in the accounting. So this is very straightforward. When you look at the second part, they raised $5. They sold 1,000 shares at $5. So that's $5,000. They raised $5,000 in cash. But this is where the accounting gets interesting. The first $1,000 of that is credited to the common stock account for its par value. The other $4,000 of that, because they raised $5,000, right, will be credited to something called the paid-in capital account in excess of par value, and this will be for common stock. So oftentimes you'll have one of these accounts for common stock, and the other you'll have one also for preferred stock. So this is going to be the difference. Any amount of money you raise above the par value is going to be put into this paid-in capital account in excess of par. The money you raise up to the par value is going to be credited directly to the common stock account. Anything above that value is going to be put into paid-in capital. So again, they sold 1,000 shares at $5. So we're looking at B here. Let's focus on B for a moment. So they actually raised $5,000 in cash. No problem. However, in terms of stockholders' equity is concerned, we have to split that into what was the common stock at par value. So par value was $1 per share, 1,000 shares. So $1,000 of the $5,000 will be credited to the common stock account. The additional $4,000 will be credited to paid-in capital in excess of par for common stock. You'll actually see this title of the account's actually a bit longer. So that's going to be the first trick. That's going to be the first trick, to know that anything above par value is going to go into the paid-in capital in excess account. How it looks on the balance sheet and the stockholders' equity account. In this case, we're going to assume that this company has $27,000 of retained earnings. So that's where that came from. But look at the paid-in capital. They had common stock. In this case, their common stock had a par value. This should be 1,000, right? But anyway, the par value is credited to the common stock account. Anything over that par value is going to go into the paid-in capital in excess of par for that. Okay. And so that's basically how it would look on the balance sheet. When you're going to be reading these balance sheets, you're going to notice paid-in capital is going to be split into the par value for common stock, and anything over that is paid-in capital. So in this case, ABC, they issue 1,000 shares. So issue meaning they sold, right? They sold 1,000 shares of $10 par value common stock for $12. So this is their selling price, $12. 1,000 shares times $12 is $12,000. So they raised $12,000. However, that's the amount of cash they raised. Where are the credits? Well, the first 10,000, right? The first $10 of this $12 represents par value. So you're going to credit common stock for the $10 par value times 1,000. Anything over par value, which in this case is only $2, will go into the paid-in capital of excess of par. So $2 extra times 1,000 is the 2,000. So that's why in this slide, C is the correct answer, because again, whatever amount of cash they raised, that's cash, that's debited to cash, that's easy. The crediting part is where you're splitting it into par value for common stock, and then whatever's left over goes into paid-in capital. So preferred stock is also shares of ownership. I don't know why they call it preferred. I think if I was a stockholder, it would not necessarily be preferred. Why? Well, because I don't have any voting rights. I don't have any preemptive rights. But I do have other rights, right? a little better than common stock in two ways. One, I have priority when it comes to dividends. So as a preferred stockholder, if the company is going to share a dividend, I get the first shot at it, okay, as a preferred stockholder. Then the common stockholders get the rest. Second, if the company does liquidate, I'm in line first to get any residual value outside of whatever the common stockholders have. So I'm in line first for that. So in that sense, it's preferred. But I know this says sometimes they just don't have voting rights. I haven't seen a preferred stock with voting rights. So they just simply don't have voting rights. But preferred stock, like common stock, has a par value. They have a par value. And so you're going to see preferred stock as an account at par value, and then you're going to see a paid-in capital account, paid-in capital in excess of par for preferred, to match the paid-in capital excess of par for common. So these are actual names of accounts that are real. One is directed to anything above par value for common stock. The other one is anything above par value for preferred stock, but it's still a paid-in capital account. So these accounts you need to know, just as you need to know the common stock account and the preferred stock account. So here's an illustration with preferred stock. So here we have Stein Corporation. They issue, again, they sold 10,000 shares of $10 par valued preferred stock for $12 cash. Okay, so they sold 10,000 shares at $12 cash. So they raised a lot of money, right? That you're going to debit the cash account for $120,000 because that's how much cash they raised. However, now when we come to the credit side, we're going to have to split that up into the amount that goes into the preferred stock account, which would be the par value. And anything above the par value is paid in capital in excess. So the first $10 of all of this cash is going to go to the preferred stock account. So 10,000 shares times $10 gives you preferred stock of 100,000. The excess, right, over $10 because they sold it for 12. So that excess is going to be credited to the paid-in capital account for preferred stock for 20,000. So again, that's how they break it up in stockholders' equity. Par value gets credited to the specific account, common or preferred stock. Anything above that par, paid-in capital in excess. Okay. Again, preferred stock, very much like common stock, may or may not have a par value. Most of them do. They will have some type of stated value. So we're going to start with simply looking at and reviewing the accounting for issuing stock. Okay. So again, that issuance means they sold shares of stock in exchange for cash. Here we have Cayman Corporation. They began operating on March the 1st by selling 100,000 shares, a lot of shares, of $1 par value common stock for $12 in cash per share. So they raised a lot of money on March the 1st. Right. Again, the first dollar of that, of each share, is going to go to the common stock account. Anything above $1, and there's lots to do, will go into the paid-in capital in excess. Right. So on March the 1st, they raised $1.2 million. That's 100,000 shares for $12 cash per share.
Actually, it says May 1st near the cash.
Oh, okay. So this should be March 1st. They have a date issue. Thank you for that, pointing that out.
Problem.
So the first dollar of that is going to be for the par value of common stock. So we're going to credit common stock for $1 par at 100,000 shares. So 100,000 of this is taken care of. All the rest paid in capital in excess of par for common stock. So that would be the proper, let me change that to an R for March 1st, right? That would be the proper entry. Now look what happens on March. Oh, I said May. March 28th. Cayman goes ahead and issues 1,500 shares of $10 par valued preferred stock. And they sell them for $30 each. So it's a lot. So we have to do the entry for that. So again, back in March here, March 28th, they raised, again, you have to look at it, $30 times 1,500 shares. So they raised $45,000 of cash. Of that, the first $10 of every share is going to go to the preferred stock account. So 1,500 shares at a $10 par value means preferred stock will get credited for 15,000. Anything above that is paid in capital in excess. So we're going to be crediting paid in capital in excess of par value for preferred stock for the additional 30,000. And thus that's done. So the first part of this is making sure we understand the issuance of stock and how to do the accounting there. But public companies, since this book is on public corporations, you've probably heard of corporations buying back their shares. As a matter of fact, that's one of the bigger criticisms of the tax cut that happened in 2017. Corporations got a very large tax cut, and they already had a lot of cash. So what they did with the extra cash is they started buying back shares. Right. So that means the corporation itself buys shares from people who already own the shares on the market, and they buy it. That is what we call treasury stock. So corporations that buy their own stock, that's called treasury stock. Treasury stock, however, is different than what we've just learned. Because you got common stock represents ownership. It has voting rights, blah, 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 rights to dividends. Same thing for preferred stock represents ownership. They don't have voting rights, but they certainly have preference in terms of dividends. All that is important. Treasury stock, the corporation forfeits all those rights. So when a corporation buys its own stock, it basically acts like it's dead stock. It doesn't really count there's no voting rights to it if the corporation owns its own stock. They don't get dividends. They don't get anything. So treasury stock is subtracted out of stockholders' equity. The treasury stock account, in essence, is a debit. In a credit world, stockholders' equity is a credit world. All these accounts are credited, right? Treasury stock is just the opposite. It shows less ownership for the public. So thus it's subtracted out. So again, in a quick review, treasury stock is when the corporation buys its own stock. Okay. Why do they buy their own stock? Lots of reasons. Probably the most reasonable one is that if a corporation promises management or employees stock options as part of their compensation, the corporation has to own that stock in order to give it to the employee. So that means that they have to go and buy certain shares of stock to meet any obligations they've offered to their management and employees. So that's a very good reason to buy their own shares, because they've promised them to the management and employees. There are other reasons that could manipulate things in not as clear a way. One is sometimes companies buy their own stock because they want to be noticed. They want increased trading in the company's stock in the stock market, so it starts making more news. And so that is one way that they use it that manipulates the news in the market. Sometimes they buy their own shares, so they can actually have that money, though that access to capital, to buy other companies. A lot of companies buy other companies out. It's not all for cash. In some cases, it's for stock as well, and it's the treasury stock that they use to have the money to buy the other company. Part of the manipulation of buying your own shares is there's less shares outstanding, which means that when you take your net income and you divide it by the total shares outstanding, there's less of them. That means your earnings per share look higher because corporations cannot get earnings per share. So their treasury stock is not counted towards earnings per share. So if there's less shares out there, then each share gets more of the earnings. That increases earnings per share. Okay. So there's lots of reasons why corporations buy their own stock, and those are some of them. So again, the purchase of stock by the corporation is dictated by the cost method. Whatever they paid for the stock is what the cost is. So the question that is in the chat is treasury stock is subtracted from stockholders' equity? Yes, but not subtracted from outstanding shares. Well, actually it is. It's not an outstanding share. And I'll get to that. So to be an outstanding share, it has to be held by someone in the public. Okay, that's an outstanding share. So treasury stock is not outstanding because the company owns it. So it's not out for public purchase. So when corporations buy their own stock, they debit the treasury stock account for whatever the price that they paid for. Okay. So again, treasury stock is a debit side account. So it's a contra stockholders equity account, right? Remember, contra accounts have the opposite balance of a normal account. So stockholders equity accounts have normal balances on the credit side, but the contra means that this account has a normal balance on its debit side. Okay. So, so how it works is this. You have a corporation. Here we have Mead. They have their stockholders' equity listed here, showing paid in capital, common stock, $5 par value. 400,000 shares authorized. Remember, the authorized shares is simply the legally recognized shares that are part of that application. Okay. Just because it's authorized doesn't mean you sold it. Okay. So to have authorized shares is simply legally recognized shares of stock. Then corporations have to sell them. They have to issue them. So the shares that are issued are the amount of the authorized shares that have been sold to raise money. So of these 400,000 shares that are authorized, legally recognized shares of stock, this company has only sold 100,000 of those. Okay, so they've issued 100,000 shares. All shares are held by the public, so all the shares are outstanding. Okay, so that's how we would read this. Then look what happens. A few days later, Mead itself buys 4,000 shares of its stock at $8 a share. Okay, they're buying shares that are outstanding. That's the only shares they're allowed to buy, the ones that have already been sold, already been issued. So they're buying 4,000 of those shares at $8. So again, we recorded at cost. we would debit Treasury stock for the $32,000. That's the 4,000 shares times the $8 per share. That's the 32,000. And they would have to pay for them in cash. So we credit cash. But now look what happens to the balance sheet. The balance sheet will change. Okay. We still have common stock, $5 par value, 400,000 shares are authorized, right? Legally recognized shares of stock. The company issued 100,000 of them. They sold off 100,000 of those shares. However, only 96,000 of those shares are still held by the public. They're still outstanding. Why? Because 4,000 shares are owned by the corporation as treasury stock. So that's sort of the pecking order. You have how many shares you've sold that's issued. Subtract out how many shares of treasury stock. The difference will be how many shares are still owned by the public, how many shares are still outstanding. And so that needs to be disclosed. And you will read this on balance sheets of large corporations. They're a lot more detailed because they have a lot more shares, but it reads the same way. So you have to know how to read this. That's the bottom line. Okay. So treasury stock may be repurchased for all these reasons. Really. So we're going to wrap up learning objective 2 with looking at treasury stock in a little bit more detail, right? Practicing this. We have a company, Santa Anita. They they purchased 3,000 shares of its own common stock for $180,000 in cash. It's expecting to hold that until a later date. So what's the journal entry? Okay, well, the journal entry is you would debit treasury stock for the amount of money they paid for it. So they paid $180,000 in cash for those shares. You would credit cash because you pay for it in cash. And that is it. Okay. So a lot going on here, but I think it's important just that we kind of take it one step at a time. So again, that the issuance of stock, both whether it's common stock everybody has, only about 7 or 8% of corporations have preferred stock. 100% of them have common stock. So preferred stock is somewhat of an after the fact. We want to raise money. We'll do it with preferred stock rather than issue more common stock. Happens. And then, of course, when they buy back their shares, right, that's the treasury stock. And again, authorized comes with the application, legally recognized by the state. Then they decide how much of those authorized shares they sell or issue. Then, of course, you have to subtract out anything they buy back as treasury. The rest is outstanding. Very important things to know. How'd you do?